I'm Adam Myers and I lead the distribution team at Pengana. Thank you for joining us for our second webinar in this series, an update with Rhett Kessler, CIO and Fund Manager of the Pengana Australian Equities Fund. To give a quick introduction for those less familiar with our business, at Pengana, our key aim is to offer our clients differentiated strategies which will add value to their portfolios. We have no me-too funds in our business. Today, Rhett will discuss how he's thinking about his dual objectives of capital preservation and delivering a reasonable real return in the current environment of economic uncertainty and elevated asset prices. During the presentation, if you have any questions, please enter them in the question box, which is accessed from the icon on the bottom of your screen, and we'll get to as many of these as possible during Q&A at the end. Rhett, over to you.
Thank you very much, Adam, and thank you everybody for taking the time to come and listen to me. So we've been putting up this slide for ever since the inception of the fund, and I'm really going to talk to it in slightly different lens. We think investors' needs are absolutely capital preservation in real Australian dollars, and secondly, we think that a reasonable real return constitutes whatever the risk-free rate is, plus the equity risk premium of 6%. Now, the reason we chose the risk-free rate was because we thought it was a fair proxy for inflation. And so we thought that if we could deliver inflation plus 6, that's the way that you either create or maintain financial independence. Given the unusual dichotomy of a very low cash rate, which is an attempt by both the Reserve Bank in Australia and central banks globally to try and stimulate the global economy and keep their currency at a reasonable level, we think there's been a dislocation between the risk-free rate and inflation. And so we're very aware of it, and we're not walking away from that. We still think that inflation plus 6% is the right number. Because really, very simply put, our mandate is to preserve and grow the purchasing power of the funds entrusted to us. Now, if you think about this, all your clients, if I'm speaking to financial planners, or your own money, if I'm speaking to direct high net worth clients of ours, is the way you stay rich or create being rich is to grow your purchasing power. And it's problematic at the moment. It's non-trivial because leaving money in cash creates a real problem, both from the sense that you don't get any return for it and for the sense that, that you may be inflated away from your purchasing power. So if I go to the next slide, given this is our backdrop, there's absolutely a time to be disciplined and a time to be brave. As we saw last year, it was tough. We started the year exceptionally nervous, where we had tons of cash and lots of insurance. Not because we knew COVID was coming, but because the market we thought was fairly overvalued and there were lots of risks. Those reserves, if I call them that, and that optionality gave us a lot of firepower and a lot of psychological wholeness, if I can put it that way, to deploy enormous amounts of capital. And we did about $150 million into an incredible environment in hindsight of real value. Now, I say with hindsight because at the time it was tough. I remember many times walking around my desk trying hard not to throw up because I felt sick, having just bought stocks that had fallen another 5%, and then forcing myself to sit down and buy some more. But it stood us in really good stead, and the discipline was there. Now, I put this slide up because we think this is a time to be very disciplined, and it's a time to be very cautious. And so people have asked us, well, where do you think we are in this market? And I think we're really in the euphoria anxiety phase, right? Fortunately, there's quite a bifurcation in the equity markets. That's the main market we play in. And so there are lots of opportunities because a whole segment of the market has been left behind. And so if we go to the next slide, please, Adam. Here you can see the real dichotomy or bifurcation of markets, where you have the financials and resources, and on average, the ASX 200 being, moderately to expensively priced. However, there's a whole component of industrials, excluding financials, where there's a lot of big cap stocks with very, very sexy multiples because they've got very, very sexy tech stories, really changing the average up to 28.6 times. And that's an environment that I think requires a lot of caution. Yes, there's a lot of stimulus. Yes, interest rates are really low. But as you'll see, I'm building a story about that there's a reason to be optimistic, but there's also a reason to be disciplined. And so if we go to the next slide, please. I often make the comment that I think I won a lottery ticket to end up in this country. And we see some very real reasons why Australia has done exceptionally well. And we think will continue to do exceptionally well on a relative basis. Firstly, the largest export of Australia by a country mile, which is iron ore, is doing exceptionally well. It costs approximately, maybe as much as $15 a tonne for Fortescue, Rio, and BHP to pull approximately between 150 and 200 million tonnes of iron ore out of the ground in the Pilbara region, put it on a train, send it the 1,500 to 2,000 kilometres north to Port Hedland, drop it onto a ship. That's the total cost of operating. Interestingly, they don't allow the ship to leave until whoever's bought the iron ore has actually transferred the money into their bank account. And as you can see from that chart, they're achieving anywhere between $150 and $170 US a ton for that export. And they've been doing that consistently for some time now. Now, we think the long-term average for iron ore has to be much lower. And the reason we've got to this phase is because one of their main competitors, Vale, has had difficulties. And secondly, because there's an infrastructure boom going on around the world as countries try to stimulate global economies. But every day that goes past at this level puts more and more money into obviously the company's coffers, but more importantly into the tax revenue coffers of Australia. Another interesting coincidence or positive coincidence is if you look at the bottom two charts, the very high orange bar near the right-hand side of the scale on the left-hand corner is the wheat production that of the season just passed. And then the rest is forecasts to the right of that. We've had an incredible wheat harvest, but coincidentally at the same time as global wheat production has not been that flash, which means if you look at the right-hand chart, you've got a very high wheat price, which is unusual. Normally you have big production and low prices, but the export has been very strong. Typically it's in the top 10. Wheat is an export for this country. This year, it'll be closer to top 5. So again, is one of the reasons why regions are doing so well. Next slide, please. Now, one thing we were particularly concerned about when COVID hit was there are a lot of companies and a lot of industries that are tied to international incoming tourism and international students coming to study at local or domestic universities. And due to the lockdown, the global lockdown of international travel, both these sectors fell off a cliff, particularly incoming tourism. And so we're worried about the impact it would have on this country. Again, being the lucky country, Australians as a whole spend more, and we're talking billions more billions more than the international incoming tourists as well as students combined. And that has meant that we're ahead in terms of this lockdown. And you can see the benefit of all that money flowing into Bunnings, domestic holidays, second-hand cars, etc., as people who are unable to travel spend an enormous amount of money on renovations and domestic travel. Next slide, please. Probably the one that has the longest legs is the fact that Australia has managed the impact of the pandemic exceptionally well. The government, I must say, has responded exceptionally quickly and powerfully with its stimulus, with JobKeeper and JobSeeker, all kinds of cash flow inducements within the economy. And so we've seen employment hold up exceptionally well. These stats do not include the March stats, which show that, quite clearly that employment levels are now above what they were pre-pandemic. And that means that there's fairly full employment, and Australia's become a very attractive place to be. The reason I say it's good for the medium to longer term is that we feel that as soon as international lockdown is lifted, we are going to see large internal migration, net migration into this country due to the higher employment levels and the fact that the government has managed this pandemic really well. We're also aware of many companies that have, in conjunction with government visa focus, have gone offshore and targeted expertise in important industries and have facilitated them coming to Australia with their families. And we're not talking hundreds, we're talking thousands of people who've been allowed in. Obviously, this has overflowed into expats wanting to repatriate to Australia. And that's one of the reasons why you're seeing a very robust top-end property market as people come back. So next slide, please. Now, before I paint too rosy a picture, I did start off by saying that managing money in this environment is non-trivial, given that our underlying mandate is to preserve the purchasing power of the money that has been entrusted to us. It's an environment where you get nothing for cash, you get next to nothing for term deposits, you get negative real interest rates for giving up liquidity and going into fixed interest government bonds. We're seeing properties change hands at 4% cap rates, which is extremely tight. And that's the big logistics deal that was done yesterday by Blackstone. And so what we're thinking at the moment is that we need a highly disciplined plan to navigate through this very difficult environment. I'm sure, if you're a financial planner, that your clients are clamoring for some kind of yield, because at these levels of term deposit rates or fixed interest rates or property yields, they are stuck between really cutting back their lifestyle or digging into capital. And so here is our thinking, if we go to the next slide. Firstly, we have one major conundrum, and that is that the value of long duration assets go up when the cost of money goes down. And as you can see from that chart, if just analyze that chart for a second, that is the long history of long yields, so tenured US Treasury yields. That's really the cost of global money. And as you can see, it's never been lower in the almost 300 years that covers. Furthermore, anybody, including myself, who's been in the market for the last 20 to 30 years has had the benefit of ever lower interest rates. Ever since I've been in this country, every time we've had a speed wobble in the economy, the Reserve Bank has cut interest rates. And as you can see, we've come all the way down from the late 80s, early 90s to the lowest, one of the lowest levels ever. And the Rba Cash Rate domestically is 0.1%. Now, this is difficult if you've got, if you're a 25, 30, 35-year-old trying to build an asset base, I don't think you're going to have the benefit of ever lower interest rates as you build your property or share portfolio. Instead, you may run the risk of higher interest rates and the negative impact they have on long duration assets. So this is a problematic environment we have. Secondly, if I can go to the next slide, please. I suspect that after 30 years of fairly stable and low inflation, there's a good chance that no one really has any clue as to how to manage inflation. I remember growing up with stagflation in South Africa and the diabolical impact that had on wealth, because you got no growth and inflation. Now, I don't for 1 minute think we're going to have stagflation here, but given all the signs, it really does look like inflation may be creeping back. And the reason I say that is because, very simply put, the definition of inflation, or what causes inflation, is more and more money chasing the same amount of goods and services. And so I ask you, if you look around at the moment, whether it's building material costs, second-hand cars, domestic holidays, school fees, medical expenses, house prices, you name it, we're seeing a lot more than 1.5% per annum inflation, which are the ABS stats. And that's our major concern, whether it's only temporary or it has longer impact. Now, probably one of the bigger causes of problematic inflation, besides more money chasing the same amount of goods and services, is the fact that if inflation expectations change, and so as before, if your local barista put up his cup of coffee from $3 to $3.50, or from $3.50 to $4, invariably customers would migrate to the guy next door or around the corner, because there wasn't supposed to be any inflation. What we're seeing currently is there's an acceptance that higher prices are a fact of life. And if that becomes systemic, that's the biggest issue for more inflation. All right, if you go to the next slide, this all brings us to our thinking that we are facing three conundrums in managing and being stewards of people's money. The first one is, what is a dollar worth in any currency, given that the printing presses are turned on full blast? So we're talking about a dollar of cash here. And as you can, as I've already commented, I think this is a non-trivial issue. The second conundrum is, what are the sustainable level of real interest rates, given that it beggars belief that if I'm right about inflation, why would you buy government bonds, so lend money to the government for 10 years at a negative real interest rate? Why would you lock up liquidity as well as subject yourself to negative real interest rates? And then conundrum 3 is, how do you preserve purchasing power in this environment? Now, we have a solution, but I just wanted to try and frame it so we're very clear on what the issues are, that every day when we come into the office, stay at home, but stop working, because we're all working from home, how do we deal with these issues? So let's go through it. So next slide, please. So there are the answers. And we think that a dollar in any currency is worth less as more and more money chases the same amount of goods. Second conundrum is, we think sustainable real interest rates are higher than this current level, because we think investors are unlikely to accept negative returns as risks ratchet up. And I cannot get away from this issue. Remember that our children or grandchildren are going to have to repay all the stimulus. And I'll tell you some anecdotes. So we speak quite often to the management of CSL or ResMed, given our positions there, plus locals in Sonic and Ramsay Healthcare, etc. And one of the questions we often ask is what kind of pushback do you get from the costs of providing your products to government departments, given budget constraints. And we've had long conversations about this over the last few decades. What has been interesting is the current response from management is that, and they deal with 120 government health departments around the world, maybe more, is that their common response is that they haven't had budget constraints come up as an issue since pre-COVID, because the spending has been so big that everyone's blown their budgets, and therefore there aren't budgetary constraints anymore. Second point is that every time the US, the UK, Australia, anybody has come to the market to raise or issue treasury bonds, it has tended to surprise on the upside in terms of the quantum. The bizarre thing is that they've got the bond placements away quite easily in most cases, but we are certainly at the upper end of requirements. Now, if you're the government and you're in charge of inflation or measuring inflation, you're kind of caught between a rock and a hard place, because if true inflation is much higher, it's absolutely not in your interest to push up A, your funding costs, and B, remember that most welfare benefits are indexed to inflation. So at the moment, we're in this interesting conundrum where it's not in anyone's interests to have high inflation. But given the amount of stimulus, I think it's a natural outcome. So that leaves us with Conundrum 3, and how do we preserve purchasing power in this environment? And I must say that all roads lead to hard assets. And so for some time now, maybe we're a bit early, but for the last year, we have been focusing laser-like on companies that, and if I had to articulate what a hard asset is, it's a company that has assets which, provided with the power, the pricing power to pass on any input costs to their customers and resist pricing being introduced into their company by resisting the supplier input costs. And there's a couple of ways you can have that pricing power, and we've listed a few there. Obviously, long-term contractual agreements have to be with strong counterparties. Otherwise, if they fall over, those contracts really aren't worth much. You have to own unique or scarce assets. Being the lowest cost producer gives you a lot more room to move than your competitors. And if you own superior or non-trivial intellectual property, and obviously there are a few others. So if we now page to the next page, please. So what does our portfolio look like? And as you can see, we're filled with what we call defensive toilet paper and toothpaste type businesses. Those are the ones in beige. So examples of how inflation would impact on these. Telstra is our largest holding by quite a long way. We think it, and maybe I'll talk about that in a bit more detail later, but essentially its businesses are unique assets, lowest cost producer, and then a really nice chunk of it, 25 cents in every dollar, is actually an inflation protected business, which is it gets an income stream from the NBN, which is linked to inflation. So it's a really nice holder. We have a lot of financials, and remember, most financials borrow short and lend long, and that a steeper yield curve is really quite positive for them. CSL, Aristocrat have really strong intellectual property that they're able to monetize. Interestingly, our Woolworths is probably the easiest one to explain. Woolworths will actually move more boxes, the same amount of boxes in an inflationary environment, but for more money. And so your absolute level of profitability should go up. Now, when we look at this slide, I want to make a couple of comments. The first one is the cumulative weight of the top 10 holdings in the portfolio is 46%, so it's quite concentrated. We completely benchmark unaware because the cumulative weight of those stocks in the ASX 300 would only be 18%. Secondly, the underlying after-tax cash earnings yield for these businesses, for the portfolio as a whole, is just under 7%. And so a lot of people have said to me, Rhett, what do you think your portfolio will do in the next year? Frankly, I don't know what the market's going to do. But if we're in defensive, high-quality companies with pricing power and robust balance sheets and competent management, we feel that as we tick through the year, that 7% after-tax cash earnings yield will accrete to us as shareholders. And so that's our base assumption. Secondly, we think there will be some some multiple expansion because we think that our companies are cheap. But thirdly, probably the most important, is that all of the companies that we've invested in have got incredibly robust balance sheets, to the extent that several of them, we've been quite harsh in our management meetings, saying, what about paying more dividends? Why have you got such a robust balance sheet? And the answers of the management team and even the board have been that this is an uncertain time. We think there may be opportunistic M&A over the next year, which will be accretive for earnings. And if there isn't, you can expect some nice dividends uplifts in the coming years. And so we think that in an uncertain time, owning hard assets that are well resourced in terms of robust balance sheets, as well as having very strong positions, we think that they'll do exceptionally well. If we go to the right-hand side of that slide, I just wanted to point out that for the first time in a long time, just over a year, we've started buying options again with a notional exposure of -4%. I do want to highlight that that's at a delta of about 25%, which means that if the market does fall, those options, that insurance will get much bigger very, very quickly, as we saw last year. Now, I hope and pray that we tear up those options as worthless, but we do feel that there's a coincidence of higher risk where you've got a very robust equity market, ever lower yields on term deposits, which means that money is just flowing into the market. You've got all kinds of bubbles like NFTs, SPACs, cryptocurrencies, IPOs of companies that make no profits, trading at unbelievable multiples of revenue, etc. And we think it's just prudent to take advantage of very low volatility to buy puts again. Cash has been building. We're currently at the end of March, we're at 9%. We did find some things to buy, so we got down at 8%. But really, the optionality about holding cash is still there, but it has been diminished by the fact that we get paid nothing for it. And you don't want to be stuck in cash for too long, given the issues around potential inflation. So that's quite a useful slide. It's quite a nice synopsis of where we are. I guess the other thing that we haven't had for many years, but has been a recent feature, is the resource stocks. And I do want to highlight that those are 3 companies. The biggest holding in that aggregate of 7% is Evolution Mining, where we think we've got the lowest cost factory for producing gold, as well as very competent management and a very robust balance sheet. And then obviously we've got the iron ore companies, Rio and Fortescue, which we don't anticipate iron ore prices standing around this level, but if we put it down to $80, which is less than half, we can still buy these stocks at a 10% plus after tax cash earnings yield. So I'm going to move on from that. If we can just go to the next slide, please. And this is why I sort of delayed speaking about Telstra earlier. But I just wanted to do 2 things. First of all, it is our biggest holding. So I do want to talk a little bit about why it's our biggest holding. And we have just under 8% of the portfolio in it. But the second is also just a refresher on how we think about companies. So first of all, what are we buying? So 65 cents in every dollar we put into this business is really the mobile business. that is an aggregate of the operating, so selling mobile phone services on the country's largest and most robust network. They're also the lowest cost producer of data gigs of data, and that's because they're way ahead of everybody else on 5G. Secondly, it also includes all those wonderful assets that are now being priced at these ridiculous multiples as communication companies around the world seek to unlock value, and that's the infrastructure of mobile phone towers and other infrastructure. We think it's a bit of financial engineering to unlock them, just to demonstrate the value. So we don't think it actually changes the value, but it just maybe makes it a bit clearer. There is also the recurring NBN income stream. The rest are really rounding errors, right? So every day the press has got some article about Telstra and what they're doing here, there, and everywhere. And so what we try to do is show that when you buy Telstra shares, you're buying the best mobile phone network in the country, and you're buying a really nice inflation protection bond from the government. Second question, is management competent? Well, we think they've done a pretty good job in the face of very, very hostile press, and at times becoming the battleground in the political battles between the Liberal and Labor parties. And we think they've continued to execute on things like premium pricing and becoming the lowest cost producer. You know, everyone says Telstra's terrible at everything. We've all got negative NPS experiences or negative customer experiences. But I will put to you that for the last 15 to 20 years, they have successfully maintained their 25% premium on pricing, and they are by far the lowest cost producer of a gig of data, which means they're decent. They must be decent engineers and decent marketing people. We think the businesses are good businesses. If any of you have got kids, try and remove Wi-Fi or data from your home. It has become the new oxygen. And so we think that that business is certainly a toilet paper and toothpaste type business. And there are a host of other reasons why we think mobile and recurring NBN businesses are really good businesses. We've been fortunate enough to buy it at the right price. So after-tax cash earnings yield of over 7%, rising comfortably, to 9% over the next 3 to 4 years and higher. And a prospective dividend yield of 5% is certainly not to be sneezed at. So we go to the next question, and I am going to finish up in soon, so I'm going to open it up to questions. I have had the absolute privilege of running a substantial amount of money, just under $1 billion, for almost 14 years now. As you know, we started just before Lehman's went bust. It's been an incredible ride over the last 14 years. This chart really demonstrates what we've sought to do, and I'm very grateful that we've been able to do it. But if you look at that, I'm just going to go through the different lines. That blue line down the bottom is the Rba cash rate. And I'm the first to say that it's too low at the moment. Right? But secondly, the other line is the RBA, the yellow line is the Rba cash rate, plus 6%. And that's the benchmark we set ourselves. So for a swimmer with that black line at the bottom of the pool, that's the line we look at all the time. And our job is to always stay ahead of that line. Now, there have been incidences when we've fallen below temporarily, and the most sort of hurtful one was last year during COVID. But what an opportunity it was to deploy enormous amounts of money at real fire sale prices. We do show the grey line to show what the market has done. Now, I'm also the first to admit that we had probably a beneficial start with Lehman's and the GFC having a real impact on the market, which we managed to navigate quite well. I will say that it has been tougher to stay ahead of a very robust market driven by the ever lower cost of money in recent years, but I think we've done reasonably well. And so what I put to you is if our job and with the money that we've been entrusted is to maintain the purchasing power of our clients' money and preserve the capital. I think we've delivered on that. So what I might do now is, I know, Adam, I probably was supposed to go for 5 minutes longer, but I'm happy to, if there are any questions, maybe go a bit longer on some of the questions.
No problem. Thanks, Rhett. We have a few that have already come in, and if experience is anything to go by, as we go through Q&A, more questions will come through. First question, please can you comment on domestic listed infrastructure assets, their current prices and the current opportunity in the face of a vaccine rollout, both domestically and globally. Also, please mention how this fits in with in your universe and mandate.
So it's quite a wide question. And if I understand, we're talking about domestic infrastructure assets, and there are quite a few, and maybe the definition of what they are is also worth just framing. So the typical infrastructure assets that we hear talked about a lot are things like Transurban, Sydney Airport, the electricity generators, etc. Now, the biggest holding in the fund used to be Duet, which was a gas pipeline infrastructure asset. We feel that some of the regulatory changes in this environment have made some of them problematic. But the real reason we've decided not to buy things like Sydney Airport and Transurban, which are the two main infrastructure assets one talks about, is the significant financial engineering that's placed around them. And they're complex, they're layered, and we're very cognizant of the issues around them. And that's really the reason. We think they're excellent underlying assets. We've just decided not to participate in those. Rather, we've looked for core underlying, what we call infrastructure assets, where we think they're undervalued, they're misunderstood, and operationally quite robust. And apologies for coming right back to Telstra, but when you've got one of the best mobile phone networks in a data-led economy, trading at an incredible yield with low debt, we think that's just too good to pass up. Other infrastructure assets that we would classify potentially as infrastructure would be Woolworths, which is the largest food distribution network, both online and within the bricks and mortar. I would stress we spend most of our time when we look at a Woolworths or even a Super Retail or a JB Hi-Fi, thinking about the upstream non-trivial infrastructure that has to go into place. So when you think about the fact that Woolies on any given day has avocados, which are seasonal fruit, or tomatoes, which are seasonal fruit, in the store, you have to think about, and in literally millions of tons, because of their national network, about the infrastructure that's been put in place over many, many years to support that. And those are the businesses we think we can certainly benefit from. And so our portfolio is quite ripe for those. Maybe next question, Adam, if I answered that.
No, that was very comprehensive. Thank you. What are your views, once we are talking about Woolworths, what are your views about the Woolworths Endeavour demerger?
So there's a couple of views we have. We used to really like the Endeavour business. It is dominant. I've always been surprised why in this country Woolworths has similar market share in food versus liquor, and unbelievably between 35 and 40% of every dollar of turnover they do is liquor, which means we drink a lot. It is a good business. The problem is the government dominates the balance sheet as a supplier in terms of duties and taxes, which is quite inefficient for a company. So that they have to pay the government on 14 days for that rather than 90 days. So that's just a working capital impost they have. I would prefer to have the choice to invest in either liquor or groceries or supermarkets. And so the demerger is going to give me that optionality. I also think that changing consumer behavior with regards to liquor is creates some uncertainties. And then probably lastly, I'm not sure I want to go on the record of this, but a very big chunk of the Endeavour business is gaming revenues. And I'm not sure that both the liquor and gaming revenues do a lot for the social fabric of our society. So I would probably feel better just buying groceries. So that's an ESG lens. They're both good businesses. Giving investors the optionality, I think, is important. It's non-trivial separating them. There is a lot of operational overlap, and that's why it's taken so long. And I think it's got some way to go still. But we think that the Woolworths business will be cleaner, simpler, and a better working capital business for having separated from Endeavour.
Great, thank you. Next question. Are you concerned that Australia, as the lucky country, may become less lucky with the withdrawal of JobKeeper and other COVID-related stimulus?
So I'm going to use the correct word. We're concerned about everything. Are we watching it? Absolutely. Do we think that, do I think that that'd be a massive negative? Absolutely not. If anything, it has tightened labour supply for ongoing businesses. So trying to get taxi drivers to get into a cab and drive through the night versus sitting at home and collecting JobKeeper is quite a tough gig. And the same goes for fruit pickers, hospitality workers, etc., etc. So I think it was incredibly positive for the economy to keep it, to build that bridge that I always talk about, the valley, the bridge across the lockdown valley. But it's certainly, as the job ads are showing us, there's more than enough work to go around. And quite frankly, handing out free, well, my kids' future of money now, in terms of taxpayers' money and just building up debt, is probably not the most productive use of that money. Served its purpose. The economy is very robust, I believe, and I think it's time to get on with it without the crutch of JobKeeper, JobSeeker. There will be some negatives, obviously. Some people, will find it hard. An interesting, maybe, Adam, if I can be allowed, an interesting sidebar is if you think about credit providers. So if we wind back a year, maybe 9 months, the biggest issue facing the banks, the credit corps, the buy now, pay laters, etc., was how should they adjust their bad debt provisions, given the fact that we were going into lockdown. The two levers that the government pulled in terms of superannuation, early withdrawals, and JobKeeper meant that the vast bulk of potentially problematic payers for credit were actually looked after, more than looked after. And so virtually every credit provider has had, in spite of taking the biggest provisions that they've ever taken in the history of the companies, individual companies, have actually had the best collection experience and the lowest bad debts. So there's something that just completely turned on its head. And so to give you a sense how much we think about this, we're now concerned that the earnings base of the credit they had out there is at its lowest level because the collections were so strong. So the revenue could be under pressure going forward. And so do they actually turn up the taps or open the taps on credit policy at a time as and when JobKeeper comes off? And so the potential for bad debt starts to rise again. And so really good management consideration of these issues we think is critical, and something we're watching very carefully. So I'm just trying to give you the different layers we think about in terms of this. And obviously we've taken, our discretionary retailers would also be vulnerable to a real pullback in discretionary spending. But if anything, we're seeing the opposite. So we're tracking each individual company and their experience, because they all went into declining sales due to lockdowns at different times. Some of them were incredibly boosted, some of them went down, and we've built a roadmap so we can track what like for like and how much is due to JobKeeper versus not being sustainable. So great question. Something we've thought about intensely, and we've built investment thesis and milestones against which we can manage it. But I don't think our experience has been that's not a big issue.
Some good food for thought there. Another very comprehensive answer. Probably an easier one or a shorter one here is, you showed a slide with your top 10 holdings, which accounted for 46% of the portfolio, having an after-tax cash earnings yield of 6.9%. Is that just the cash earnings yield for those 10 companies, or is that the portfolio as a whole?
Yeah, it's a great question. So again, without being too pedantic about the way I answer it, it is for the whole equity portfolio, and it's grossed up by 91% because we don't have an after-tax cash earnings yield for our cash. So hopefully that's clear. So it's the after-tax cash earnings yield of the equity part of the portfolio.
Great.
And it's weighted. So we take each one versus its weighting, and then we obviously gross it up for the cash.
And can you tell us a little bit about how you hold your cash?
Yeah, never been simpler. So I don't see why we would buy term deposits for an extra 20 basis points or 30 basis points and give up liquidity. So for the first time in a long time, we don't have any term deposits. We do have some hybrids, which are paying us 375 basis points above the RBA, well, above the bank bill swap rate, which is very similar to the RBA cash rate at the moment. And we only have maybe 1% of our cap, so 1% of the portfolio in that. It's very liquid, and so that's the only non-cash with what we call the burglars that we have, because we're earning nothing from the burglars, our custody and settlement price, because there's nothing to be paid. So we don't earn a negative number, but it just sits there, and we're very cognizant of that. So this is probably the simplest it's ever been. Are there alternatives without moving up the risk curve, because we're an equity manager rather than a cash manager? We haven't found any other than the hybrid, the CBA hybrid. That's very liquid. I prefer liquidity versus what's on offer.
Makes sense. If you look through your portfolio, what percentage of the income in aggregate is sourced from offshore?
Okay, so I'm just going to define what we count as income. So I think you guys, well, most people have heard me talk about non-Aussie dollar earning streams. And I'm assuming that's what you mean by, in that question, by income. So approximately 24% of the portfolio is maybe 24 to 26%. So a quarter of the portfolio is non-Aussie dollar earning streams. So there are two main categories, probably three main categories for that now with resources. So the one is we consider CSL, ResMed, Aristocrat, Amcor non-Aussie dollar earning streams, because over 85 to 90% of the earnings come from offshore. We then also have direct New Zealand investments, which is about, it's small at the moment, I think it's about 6%. And then we also consider that even though the miners are local and their costs are Aussie dollars, their revenue streams are non-Aussie dollar based. So iron ore and gold is US dollar based. And so we have to think about it as a currency exposure. And so if you put those three categories together, you get to about 25%. I will point out that typically the average portfolio, if you index match, approximately 35 to 40% is non-Aussie dollar.
Great. And last question, you've spoken about your focus on real assets and the reasons for that focus. Have you got any problems if inflation does come back into the economy?
My biggest fear is that there is a lot of froth in segments of the market. And if there is inflation and it's real and it's high, discount rates for the high growth, long, very long duration assets are only going to start making profits in 5 years. The valuations of those companies should unwind quite sharply. If there is a rush for the exit, people will look for liquidity generally, and therefore there'll be a general sell-off. Right? So that's my worst fear. How have we managed that? We've stayed in liquidity, so we've had a focus on liquidity. More importantly, we have bought the puts and got cash. So we're balancing that, right? And can I just stress, Adam, that last question is probably, that goes to the heart of the non-triviality of managing this in this environment, because cash could be your biggest sort of safe place, but also over time stands to be eroded in terms of your purchasing power the most. And so you have to balance those two. And that's why we think so hard about these things.
Great, thank you. We have no more questions, so I'm going to end at this point. Thank you to everybody for joining us today for this update. Rhett, listening to you, I couldn't help noticing that although you now have a very definite focus on hard assets, nothing else has changed. Everything else about the way you describe the process sounds exactly the same as it always has sounded. So that's very reassuring. Our next webinar in the series is next Tuesday with Ted Franks from the Pengana Web Sustainable Impact Fund. You can register for that and the rest of the webinars in the series on our website. If you have any other questions, please get in touch. We'd love to hear from you. Thank you very much for joining us.